Hello, I'm Sam Stovall, Chief Equity Strategist of S&P Capital IQ. In this week's Sector Watch report, found on www.getmarketscope.com, I reviewed stock performances during the second and third quarters of midterm election years. As we turn the page to a new month and a new quarter, history reminds us that equity price performances have traditionally been weaker than normal during midterm election years. Since 1945, the S&P 500 recorded the worst six-month stretch of the entire 16-quarter presidential cycle during the second and third quarters of the midterm election year. What's more, the batting averages or frequencies of price gains were unimpressive. And this weakness was not just a large cap phenomenon. The Russell 2000's weakest returns occurred during the second and third quarters of the midterm election years since inception in 1978. Coincident with poor price performances for large and small cap stocks, S&P 500 sector total returns were also weaker than normal since 1970. On average, all 10 sectors recorded positive total returns during all second quarters, but saw only 2 sectors do so during midterm election years, and they were consumer staples and healthcare. One good thing to be said about weak quarterly results during the midterm election years, however, is that the 3 best quarters typically followed the 2 worst. So what's an investor to do? Well, Charlie Brown once said, "I have a feeling that when my ship comes in, I'll be at the airport." Therefore, while it may be okay to become a bit more defensive during the next 2 quarters, just remember not to be in cash when the midterm election tide finally turns. I'm Sam Stovall, and I'll talk with you again next week.